Thank you. All right, so I'm going to go ahead and call this work session to order on AO 2020-98, modifying the MOA Trust Fund annual dividend calculation methodology and to broaden authorized investments. Let's go ahead and start with a roll call, please.
Miss Allard. Mr. Constant. Mr. Dunbar.
Here.
Miss Kennedy.
Here.
Miss LaFrance.
Here.
Mr. Peterson.
Present.
Mr. Perez-Verdia. Miss Quinn Davidson.
Here.
Mr. Rivera.
Present.
Mr. Weddleton.
Here.
And Miss Zalatel.
Here.
Thank you. As usual, if assembly members want to get in the queue, please put yourself in the chat or text me if you can't access the chat. With that, I will go ahead and turn it over to the administration for the presentation.
Okay, Mr. Chair, I don't know if Alex is on the line, if Alex wants to say anything before I say something. Okay, I'm going to go ahead. Go ahead.
Go ahead.
Okay, all right. So this is Dan Moore, Municipal Treasurer, and today we're going to be talking about an ordinance before you next Tuesday night, which is dealing with the MOA Trust Fund, and it's to change the methodology used for the payout rate and the calculation of the annual dividend, and that's in light of the sale of MLMP. And it's also to talk about the need to diversify the investments that the MOA Trust Fund has as a result of the trust fund getting much larger. Right now, it's somewhere around 166 million. It's going to go up to nearly 400 million after the sale of MLMP. So we have for a long time, almost a year and a half, been actively working on this coming day with the sale. And by working, I mean the finance department, myself as treasurer, Alex as the CFO, working with our investment consultant and their RVK, they'll introduce themselves here in a minute, as well as the Investment Advisory Commission. And the commission has been extremely helpful to the whole review and decision process, getting to the point that we are today. There's 9 members on that commission, and in the presentation material in the appendix, there's the list of biographies that show you the background of each of them. It's a very talented, very knowledgeable commission, and we really, really appreciate all the advice they've given. Today, the chair of the commission is Ty Schomer. He is connected to this meeting. There may be some other commission members that are also on the line. If you do have any questions or you want to hear directly from the commission, you can ask at any time. So the main proposal here is to go ahead and allow our investment consultant to go through the presentation. They're going to probably cover 85% of it. They'll defer to me for a few of the pages, and I believe they're willing to take questions along the way, because we know with investment topic it can be a little bit complicated or challenging for some people that are not living in that world to understand certain terminology or concepts. So please feel free to ask questions along the way. But we're just going to try to just go through the pages here. I'm sure we're going to take the full hour, but we do have planned time for questions along the way, plus hopefully 5 to 10 minutes at the very end. So with that, I would like to just turn it over to our investment consultant and let them go ahead and start the actual presentation.
Great. As you're pulling that up, just want to note for the record, we've been joined by Mr. Constant. Please continue.
Well, thanks, Dan. Can everybody hear me okay, first of all?
Yep. Yeah, we can.
Great. Well, thank you for having us, and Dan, thank you for the introduction. As you mentioned, we are RBK. My name is Spencer Hunter. I'm one of the team members that works with the MOA Trust. You'll hear from Cole as well as Tracy today. And just a little bit of background on who RBK is. It's not a household name, so let me try and give you a little bit of information about us. We're a Portland-based firm. We also have offices in Chicago and New York. There's about 125 of us total. About 90 of those professionals are in Portland. We've been working with MOA Trust for just about 5 years. And we do work with very similar clients across the country. We have about 200 clients total. Almost all of them are institutional investors. They range from public pension plans to defined contribution plans and anything in between. So we're happy to be here. Cole will be walking through a majority of this presentation, but if you have questions along the way, please do stop us. We're in sort of our own world sometimes when we start presenting, and we know the terminology, but if you do have questions, please, again, just go ahead and stop us and let us know. So with that, I'll go ahead and turn it over to Cole. Cole, if you want to introduce yourself and then maybe start walking with the presentation, I think that'd be great.
Great. Hi, everyone. Thanks for meeting today with us. I'm happy to touch base and explain where we stand with the trust and the proposals that we're coming to you all with today with respect to the municipal code. If you all have the presentation, I'm on page 2. Really, this is kind of the roadmap of.
Sorry to interrupt, but I'm wondering if someone can actually share the presentation. Maybe Desiree, is that something that you can do?
I can, unless one of the presenters wants to.
Yeah, I think, Mr. Chair, the presenter, RVK, was going to go ahead and control the presentation if they can be allowed to do that.
You guys should
Great.
have access. If you hover your mouse in the middle, you can see a little share tray. That's the square with an arrow. And if you click on that and then have your presentation open, you should be able to share.
Great. Did that work?
Great. We can see it now. Thanks.
Awesome. Okay. Well, this is our roadmap of what we plan to discuss today. And as Spencer mentioned, please do pause us along the way or ask questions and interrupt. We welcome that. There might be some time at the end for questions, but don't hold back with anything along the path here. So ultimately, starting off, we'll kind of go over the management and oversight of the trust fund, how it all works, who's in charge of what, where the responsibilities lie, and then we'll get into the performance, asset allocation, expected risk and return of the trust, before moving into the dividend history, both the last 20 plus years now and the next 20 plus years, and what it might look like with the additional proceeds of the MLNP trust sale, and using the different dividend formulas that are on the table today. From there, we get into the recommendation to provide a little greater flexibility within the code for certain types of investments, and we'll talk in a little more detail there, but more so talking about the path that we have gone over the last year and a half or so to get to that point in time. Ultimately, the recommendation or the proposal that we were putting in front of you all would be to increase slightly increase the maximum allowed for real estate as well as the basket clause. Currently, those maximums are at 5% of trust assets, and what we're putting in front is that each of those would go from 5% to 10%. So not too dissimilar from where we are today, but slight increases there, as Dan mentioned, try and expand and help diversify across the trust, especially with the increased assets coming in, and really help institutionalize and make this a little more broad for the group. We also have a timeline at the end, going through kind of how we've operated alongside the advisory commission and Dan as treasurer, and what the process has been thus far. So just to give a little history on the trust fund, it was established in 1999, originally about 120 million, and then over time it has grown between a little. In 2000 there was the pension police and fire pension fund settlement that was added to it, but a lot of it has been investment gains. And in addition to that, there's been a dividend each and every year, and there's a table as we get a little further showing how much that dividend has been. And as Dan mentioned, assets are at about 166 million as of the end of August here. The trust fund has a long-term investment horizon. It's not that dissimilar from maybe an endowment model. There's an expected payout of funds as that dividend on an annual basis. And the primary objective here is to maintain the purchasing power of the fund while also producing that dividend for use within the city. So we'd hopefully be able to grow that over time, but the main goal is to maintain that corpus and be able to provide that dividend each and every year. In terms of oversight, and again, please do pause me along the way here as needed. But there's a handful of different pieces at play. Per the charter, the municipal treasurer is the primary fiduciary, so that's Dan Moore, who started off here. And then there's a various groups of people that work alongside Dan and the treasurer and the CFO to help manage this trust. As code states, the treasurer works directly under the CFO, Alex Slivka. So the two of them, in conjunction with the IAC and as an investment consultant, we all work together to steward this fund. The Investment Advisory Commission is a 9-member group. As Dan mentioned, Ty Schomer is the current chair, and it's a very a lot of experience within the 9 people. We meet quarterly to discuss things with regard to the trust on kind of a regular basis, and then on an ad hoc basis as needed. For example, in 2017 we met 7 times, and in this year it looks like we're going to meet 5 or 6 times. So it's not always just quarterly. Whenever there's a need, like for education on some of these topics that we've been working on for the last year and a half, there are additional meetings to go through that. And their member bios are all at the very end of this presentation if you'd like to look through them. That brings us to ourselves. Spencer, Tracy, and myself make up the core of the team. There's a few other folks in the background along the team as well, but we are a third-party independent, non-discretionary consultant. So we're also in a while we are in a fiduciary role, we don't have discretion over those assets and making changes. Everything comes as advice to the trust through the IAC and through Dan. We provide quarterly performance reports, talk about the markets and what's been going on a broad macro level. We bring asset allocation recommendations, how to diversify those trust assets across different types of funds, equity, fixed income, real estate, different areas within the capital markets to try and help provide the best outcome for the trust. We also, within each of those asset classes, we do searches and provide ongoing diligence for those managers that run each part of the portfolio. And then there's at the end here, there's the annual reports that are required by code. There's a annual report from the treasurer and then an annual report from the Investment Advisory Commission, both of which were provided in June, I believe it was. Bringing to the next page here, those are the 2 reports in the middle of the page that were accepted at the assembly meeting on June 2nd. We help Ty come up with one of them and Dan with the other, provide any details that they need, and kind of review the last year. At that point, I'll take a pause and see if there's any questions on the history or the oversight or what type of role Dan or Ty as the chair of the IAC or RVK play within the trust, or if there are no questions, I can kind of get into the trust itself at a more detailed level.
Not seeing any questions right now, so please continue.
Great. So on page 7 here, we have what we call an asset allocation versus peers. Along the top with the green dot in the green diamond in each of the little stacked boxes is the MOA trust allocation, and this is as of June 30. We provide this on a quarterly basis. And then in the middle of the page there's how it breaks down by percentile amongst peers. So I'll focus on the median. So this is the median plan amongst a few hundred different plans that are of similar style as the trust. So at the bottom middle of the page, you can see If you combine the two, U.S. equity and international equity at 35 and just under 26%, you have a 61% total allocation to public equity versus the median of roughly 59%. So right in line with the peer median. Similarly, on fixed income, you have a 31%. The trust has a 31% allocation to U.S. or international fixed income, so bonds, versus a 33% allocation for the median amongst peers. The one difference is within alternatives. The trust has an 8% allocation versus peers having a 15% allocation, so slightly under. And that's kind of where we're focusing, and what is part of the code proposal is allowing the trust to expand a little further into alternatives. And the IAC has recently, in the last year and a half of work and education and manager review, has recently endorsed a decrease of 7% to public equity across U.S. and international, the removal of another fixed income product with bank loans, and that with a corresponding kind of increase to private real estate and private credit. So when you think about that, I mentioned equity and fixed income were about in line. We'd be slightly pulling those down in order to slightly increase alternatives. And that would kind of bring the trust a little more in line in the alternatives area. And we think that fits with the profile of the trust growing and being able to, afford multiple opportunities and the ability of the trust to manage this on a go-forward basis. On page 8 here, we have a kind of a snapshot of what the RBK performance report looks like. This page on the upper left is within every quarterly report. So the Investment Advisory Commission and Dan as the treasurer see this every meeting, but ultimately it goes through assets relative to target, and you can see those red bars is how much is it varying from that baseline target. On the right-hand side shows where we stand today with that target and where the proposed target would be if the assembly were to approve the changes that we've put forth to the municipal code. Just to jump right to it, on the green box on the right-hand side around real estate and private credit, that's that alternative space that I was talking about. So the proposed target would be 13% to real estate and 5% to private credit. Currently, the real estate target, if you look one line up, is about 8%, and would be expanding that to 13%. And private credit is currently 0% and be expanding it to 5%. The goal of this is really, on the margins to slightly increase the efficiency of the portfolio. It's a very slight increase in return with a decrease in risk as measured by standard deviation. So effectively, by diversifying to other asset classes at bigger percentages, there's less reliance upon public equity and public fixed income to produce returns and provide diversification against different types of market cycles. So the goal here would be to our projections over the long term would be slightly increased returns and in return potential over time. I do want to note though that within the trust, we work with the group to make sure we understand the risk tolerance and the goal of the trust as an entity. And so these changes aren't dramatic because the goals of the trust aren't changing dramatically. These are more changes along the margins and slight tweaks to just optimize the portfolio a little bit when possible.
Just want to note for the record really quickly that we've been joined by Miss Allard. Please continue.
Great. Page 9 here just goes through performance of the trust over time. There's a slew of different items, but ultimately the top line there, the total fund is the trust returns. So you can see over the long term, over the 10-year period, about 8.6%, and this is per year on average. 15-year, about 6.5% per year on average, and since inception, which is just over 20 years now, is just under 6% per year on average. Just to give some context as to what the trust has been producing on a return basis. And then that compares to different custom indices that we have put together to try and benchmark performance of the trust relative to what we decide the benchmarks and target would look like, and then also relative to peers. So just to give different perspective on how the trust has performed over time. And this is just a slightly updated version through July 31st, just to give you a little more context. I know July and August were quite positive. I actually have August numbers in front of me, and year to date, so in 2020 through 8 months, the return is just over 4%. So with all the volatility we've experienced this year on the downside at the beginning of the year and the rebound thereafter, back in positive territory for 2020, and the since inception return is also just under 6% at 5.9%. That's not in front of you. We had to kind of produce this ahead of time to make sure it was in front of everyone for this presentation, but I do have that from our team in the last couple days. On that note, that kind of gets us through the beginning of what the trust looks like, the oversight, who's advising on the trust and how it works, and then also the performance and how the trust has done over time. On that note, unless there are any questions, I'll pass it over to Dan for a few slides to kind of go through the history of these dividends and the dividend payout rate.
Okay, so Mr. Chair, I'll go ahead and jump in. I'm on page 11 of the presentation. What this page is showing is the entire history of the trust fund with respect to dividends paid. Dividends are paid each year, and by code, they're paid out by December 15th of each year. In the early years, if you look at this table of historical numbers, you can see there is where it says dividend percentage, it says NA, not applicable, for the first 5 years of the dividend. That dividend was very, very high in the beginning, and this is when the sale of ATU occurred. And those numbers, the budgeted dividend numbers back then, were truly arbitrary. There was no strong basis for those numbers at all. The budget had been set very, very high, and it was difficult at the time to cut the budget to sort of bring the dividend down. Ultimately, we did step it down. We went to the voters in 2003. We asked them to do what you call an endowment style payout percentage of market value approach. That's similar to what the permanent fund has tried to do over a number of years. And with that, the voters said, we will allow you to pay up to a maximum of 5% payout based on some type of average market value of the trust fund. And so with that, we further defined the average market value in the municipal code, and we stuck with 5% for the next 6 years. And then we had the Great Recession, and that was in 2008 and 9. And as a result of that, it was no longer a sustainable rate to stay at 5%. So we went to the assembly at the time, and we asked to reduce the payout rate from 5% down to 4%. And so starting in 2010, that's what the payout rate remained. And then we allowed for many years of recovery. And then fairly recently in 2017, we felt that the MOA Trust Fund had recovered most substantially from the Great Recession, and that we could afford to go up to 4.25% payout. And that's what it's been for the last 3 years. So that's the history of the trust fund. In total, in this 20-year period, it's $138.9 million of dividends that have been paid. And that's a very substantial number, but I think what you'll see in a few subsequent slides, with the addition of the MLP number, that amount of dividend for the next 20 years is going to be substantially greater. So for 2020, that's not on this table, we have a budgeted dividend of $14 million. That's an increase over 2019. It's quite substantial. It's $7.5 million increase. That is based on a special one-time adjustment of the dividend calculation. It's built into the code language, and that is taking into account a average of the last calendar year market value and the month-end market value of the trust fund at the time the sale occurs, which is scheduled for the end of October. So the average of those two numbers times the maximum rate of 5%, because we were trying to shoot for a $14 million number, which I think was budgeted. That is what we've told the budget office we will achieve. And that's a one-time calculation just for 2020. Beyond that, the long-term payout rate we're proposing in the code to be 4.5%. And RVK is going to get into the justification for that. So the next page on page 12 is just a snapshot of what the ordinance looks like. And we only put that in there so you could see the three whereases as to why we're doing this proposal to the Assembly right now. And it's in direct response to the sale of ML&P. On page 13, the next page, we reference in here that there is a full version, or what you call a red line version, of the entire code that governs the municipal trust fund. That is in the appendix, so you can see the entire code end to end. What we're going to do today, though, in the slides is we're just going to focus on those portions of the code that are actually changing, so that we can give you that detail. So that's what you see starting on page 14. This is an excerpt of the red line version that's in the appendix. And what this is showing on this particular page is our proposed definition for how to calculate the dividend year by year, starting in 2020 and then going all the way out to 2026 and beyond. And effectively, the summary of what we're doing here is, if we were to follow the existing dividend formula that is in the code right now, we would end up not realizing the benefit of the sale of ML&P for many, many years, because right now it's based on a 5-year average, and we would be taking 3, 4, 5 years to really get to a true enhanced dividend as a result of the sale of ML&P. So the approach that we're proposing is to sort of reverse engineer it and to go to a buildup of that average. Right now it's 20 trailing quarters of market value. What we're doing is we're starting out with 2 periods of market value for 2020, and then you'll see it goes to 6 periods, to 10 periods, to 14 periods, to 18 periods, and by 2026 we will be back in the same methodology that we have with our pre-existing code. By 2026, it'll be based on the 20 consecutive market value rates or amounts at that time, multiplied by the specified payout rate, which is proposed to be 4.5%. So that is the detail there. It gives us the guideline to know exactly how to calculate the dividend each year from now until all the way out into the future. So the only other change on this is just to say that the corpus of the fund, that's a non-spendable portion of the fund, includes the proceeds of ML&P consistent with what the original charter said, which is anytime a utility is sold, those proceeds go to the trust fund. Okay, on page 15, and this is
before you move on, I have a question for you.
Go ahead.
From Mr. Constant.
Okay.
Thank you. So your first benchmark there, calculating the 2020 dividend on 2 consecutive quarters ending March 31, 2021. Oh, I'm sorry, actually, never mind. I thought that was for the first year, 2020. Thank you. Move along.
Okay, no problem. All right, so I'm on slide number 15, and this is the last slide, and then I'm going to hand it back to RVK. So the other change that we're making with respect to the dividend itself, that's what this whole section is about, is to be very specific about what the payout rate is allowed under code. So what the wording says is for 2020 only, for year 2020 only, the payout rate will be the 5% rate. But thereafter, it will go to 4.5%, 4.5%. And there is a definite rationale for the 4.5%, and RVK is going to get into that. But effectively, in the illustration in these words, and this is actually in the code so people can sort of understand where 4.5% comes from, if you assume that the long-term capital market projections, that's what do you expect the market to give you in terms of returns, if that long-term projection in a particular year happens to be 6.5%, which you'll see later is an actual number that is part of an analysis done by RVK. If that is 6.5%, and also if you assume 2% inflation, the net result of that, the net payout rate, which is the real rate of return, is 4.5%. And so based on that, we feel that 4.5% is the appropriate rate to use on a long-term basis for the trust fund in order to preserve the purchasing power of the fund. And with that, I'll go ahead and pause if there's any questions, and if not, then we can have RVK comment more on the rationale behind the 4.5%. Okay, so RVK, you can jump back in.
Okay, and just going back to the prior slide, and Dan, you did a great job. Dan did a great job walking through the details here, and really the goal of this is to make sure that this is a balanced dividend over time. Obviously, as he mentioned, if we use the prior formula, this big influx of cash into the trust wouldn't be acknowledged by the dividend immediately. So it really is trying to provide as much of a dividend as possible in the early years while still maintaining a balance and not trying to smooth that out over time, which is the goal of any trust or of any endowment or trust, trying to preserve the corpus of the assets over time. And then in terms of the spending policy itself at 4.5%, a couple things there, and as Dan kind of mentioned already, if you back into this using we have every single year RVK comes out with capital markets assumptions. So this is a assumption of what each of the asset classes available for investment in the entire investment landscape, what we project them to return over the next 10 to 20 years, so this long-term time period. When you take each of those assumptions and include the trust allocation to each of those asset classes and kind of do a weighted average of those returns and the benefits that the diversification plays within it, the expected return is right around that 6.5% range using our current capital markets assumptions. Our inflation assumption is also 2% for that long-term time period, and so you kind of fall right back at that 4.5. So mathematically, this 4.5 does make sense to us. Additionally, we have on this next page, we also did an analysis relative to other entities. So the National Association of College and University Business Officers, NACUBO, the short name for it, comes out with a survey of spending rates and asset allocation performance, a whole slew of details, but one of the things is spending rates for each of these institutions, and the average spending rate was exactly that 4.5%. There's more detail in the appendix on exactly how it's broken out by different asset sizes and over time how that has changed. But the main takeaway is, as of 2019, the average is 4.5%. So RVK would support that number. We think anywhere in that 4 to 4.5% range is sustainable at current levels. If you go much beyond that and you tack on inflation in terms of the real purchasing power of the trust and that dividend over time, you're going to start eating away at the corpus more than likely of the assets, because the return that they're generating isn't going to be enough to keep up with that 4.5% plus inflation. So the purpose here is to provide as much as possible while still maintaining the integrity and the balance of the trust. I see that there are a couple of questions in the chat.
Great. Yeah, I actually just have one from Ms. Zolotow.
Thank you, Mr. Chair. Thank you. I appreciate this information. Was there any analysis or a conversation around one of the things we can do with the MLNP proceeds is pay off debt and the cost of debt to the municipality in relation to the dividend that we're likely to spin off, because debt can, of course, debt costs money. So I'm just trying to paint for myself a holistic picture of kind of not only the income side from the MLNP, but also the debt that the municipality carries that could be eligible for payoff with those proceeds. And that might be more to Mr. Moore, but I'm just curious about that.
Dan, do you want to take that one?
Yeah, I'm here. I was not directly involved in some of that analysis. I know Alex Slivka absolutely was, and they looked at all the different debt that was that would qualify for potential early repayment, and considered what that rate of borrowing was versus what the MOA trust could generate according to these projections. And I know that one of the areas I believe was a convention center, and there was some prohibition on actually paying that down. So I do know a lot of time and effort was spent. I was not directly involved, but Alex Slivka could give you more details if you need to know all the different areas that they explored. But this is what we're talking about is the net proceeds from the sale of MLP after we pay off their debt. And as far as I'm aware, there was no other debt opportunity that was that exceeded the potential that we could get from just investing the net proceeds in the trust fund.
And through the chair, this is Alex Slivka to Ms. Zalatel's question. That's correct. We have explored everything. I think we'll remind the Assembly just on the broad geo debt that we recently refunded all the debt that we could at an interest rate of 1.71%, I think, tax-free. So you're going to be seeing on the addendum for the 29th meeting a resolution related to proposal of how to use the proceeds of the MLMP sale. And there are a couple things that we're going to look at. There is one open item that we're trying to explore whether we could, the piece of debt, whether it does qualify for use. That's an open question we're trying to answer and that we hopefully may have an answer for next week. But we have looked high and low for everything that would make sense, and there wasn't a lot of it other than the direct MLMP debt.
Thank you.
Great.
Thank you. Please continue.
Okay. So that kind of gets us to where we fall on the recommendation for the spending rate and how that formula is broken out as Dan mentioned previously. And so the next step here is to show you what dividends could look like into the future using that smoothing formula and that 4.5% spending rate. So this table is an assumption of that 6.5% return per year, which I will say, this is a long-term average return. So this assumption, because there's no other real way to do it, assumes 6.5% per year. You're going to have years that are higher than that, and you're likely going to have years that are lower than that. But over time, it should smooth out to that 6.5%. So each and every year is almost assuredly going to be "quote unquote" wrong on this assumption. But over the long term, the directionality should be correct over time. And you can see here in 2020 the dividend of $14 million that's in the budget, and then how that increases over time in two phases. One, the investment return that's added here, and this it includes the dollars that are coming out for the dividend, but also the smoothing effect of the MLMP dollars that are coming into this formula each and every year. So you can see that it ranges from 14 million to, in 20 years from now, just over 25 million per year. And that's using that 4.5% dividend for each and every year after 2020, where it's 5% just for 2020. It's a total of 411 million in dividends over the next 20 years. And as Dan mentioned before, the prior 20 years were 138 million. And again, that's because of two parts. One, and a major part of that, the MLMP dollars that are more than doubling the size of the trust. So in turn, more than doubling, or in equal pro rata percentage of that dividend increasing, but also the slight investment gain over time for the trust. Any questions on that page at all? Great. This next page really is just showing the incremental change in budget of the SEE. No major comments here. Along the bottom, you can see that change relative to the current budget. with all these changes taken into account. Page 19 here is one of the other main points of this presentation, and to try and get familiar with you all. And this would be another change to the code. And as I mentioned before and kind of previewed, we're recommending increasing the maximum allowed to real estate, which is item 3 there in the middle of the page, from 5% to 10%, as well as the basket clause from 5% to 10%. For frame reference here, currently the trust has an 8% target to real estate. So we're using the 5% target, or 5% max listed, plus 3 of the 5% allowed in the basket clause, for a total of 8. The IAC has kind of endorsed alongside Dan at the recommendation of RBK to increase that real estate allocation to 13%, assuming the code does change, and then a 5% allocation to private credit. So we'd use the full 10% of real estate, another 3% of the basket clause for real estate, for a total of 13, and then an additional 5% also falling in the basket clause to private credit or private debt, as shown here. So staying under the 20% total combined between the two. And really, as I mentioned before, this is trying to improve the chances of consistent and balanced returns over time, and also would more fall in line with what peers are doing in terms of their alternatives allocation. The institutional investment world is constantly changing and adapting to what's available in the marketplace, and alternatives is a space that has made a lot of progress over the last 10, 15, 20 years in terms of the availability for institutions to invest, such as the trust. So this is an area where we focus a lot of time at RBK. We have an entire research department, and that kind of goes to this next page here. An entire research.
Actually, I have a question for you from Ms. Zalatel.
Thank you. If we could go back to the last slide, could you give me some examples of what the basket clause type investments would be? So if I'm speaking with constituents, like some firm examples.
Yeah. So on the bottom of the excerpt here in 4A2, we kind of list out some of the options here. So hedge funds, private equity, private debt, inflation hedge products. So these are just other areas that are kind of fall in that alternatives bucket outside of public equity and public fixed income, for example. Is that answer your question, or are there other details you'd like to flesh out there?
Could you give me a couple for examples, like actual concrete type products that might be there, so that real estate is really clear, but that's a lot of jargon. Yeah. And I understand it's your world, but it's not everybody's. Thanks.
Yeah, absolutely. So, real estate, as you mentioned, it's a collection of buildings that are owned and packaged up into an investment product. Private equity, different than public equity, are companies that are owned privately and are not listed on a public index, public forum, and owned separately and tried to produce value within the company over time. Private debt, and a public entity can issue debt, and the people that purchase that receive that interest over time. It's very similar, but just on the private side. So it's issued privately rather than over a public forum. Spencer, do you have any additional comments there on maybe specifics of the basket clause?
Sure. So, one of the things that you could think about basket clause, moving to those real return and or inflation hedge products, think about this. This could include something like infrastructure. So if you make an infrastructure investment, what the MOA trust would do, it would commit to a private fund that invests in infrastructure deals that might fund, the most kind of used example would be a toll road. So you might kind of own the interest of a toll road over time. You could help fund the construction or rehab of a hospital or of schools. So it could really be anything. And I think that's kind of the purpose of the basket clause. But realistically, what we're really talking about here is that private debt for now. And that private debt, as Cole mentioned, is essentially the the MOA trust would own interest in private debt that is being not offered in the public market, but rather being offered by a private fund structure. And that debt is offered to private companies that are typically smaller and can't access the public market. So you're helping smaller companies with debt needs, and you're getting paid interest in return. So, I think the basket clause is vague right now, or not vague. It's very flexible. I don't think there's any plans on using all of those, but certainly some of those may come into play shortly here with private debt. Real return and inflation hedge is a little bit more convoluted, as that could really include a lot of different things, but I think infrastructure is a really good example there.
Thank you. And may I ask one more follow-up, Mr. Chair?
Sure, go ahead.
Thank you. Does the municipality give any guidance or principles on the types of investments that we are willing to invest in terms of like general principles? I mean, that's such broad, and private equity and private debt in particular could be things that maybe, I don't know, don't always have the best outcomes in some of our minds. And so I didn't know if we provide any general parameters around investments, throughout the use of municipal money in this way.
I think municipal code is one of them. So this item that you're referring, what we're looking at here is trying to provide guidance on where you can. The trust fund has an investment policy statement within that that kind of outlines the areas that would be invested in. But maybe if Dan has anything, or Spencer there to further expand.
This is Dan Moore. I'll just weigh in real fast. The investment policy is an internal document that we work with the commission, with the consultant, and that's kind of our guiding principles. There are no guidelines coming from the assembly. The world of investments is highly specialized, and what we're dealing with is what institutional investors would invest in. So it's not something a normal retail investor would even be aware of or knowledgeable about. So in terms of what we actually invest in, these basket clause areas are basically giving some latitude, but in what we're proposing, effectively, we're only left with 2% unspoken for latitude, because we're proposing specifically to increase real estate and to start to invest in a private debt manager. We actually have three different managers that we've already selected, and if the code is changed and we have the authority to go forward, we will go ahead and sign contracts and place money with them. But to be specific, the two real estate managers, these are private real estate investments, are Harrison Street and Invesco, and they have their own particular special approaches to real estate that went through a very detailed vetting process with the Investment Commission. And then for private debt, we plan to use PIMCO, and they have a product called Private Income Fund. And all these different types of private investment products are done through limited partnership agreements. And that is the structure that we go with. They are definitely very different from any type of publicly traded stock or fixed income security that the general public may be a little bit more aware of. These are very different, more specialized, and they're more for the pure institutional investor to make use of. So.
This is Ty. I think maybe more to speak more specifically to her question. The municipality doesn't give us any policy or restrictions, but I also want to say that the board, in its discussion about these things, is not insensitive to those things, and also wants to make sure that we don't incur any reputational risk that's unnecessary and that type of thing too. Does that answer your question a little bit?
Yes, thank you very much for all those answers. It's all very helpful.
Thanks.
Great.
So we have about 10 minutes left in our time today. I know we have quite a few slides left to go through. So go ahead, go to Mr. Peterson, and then we'll finish up the slides.
Thank you, Mr. Chairman. And I just wanted to follow up on that same question a little bit. How do you go about choosing which private investments to invest in?
Great. That actually is a perfect segue to page 20 that's on this chart that I had started to talk about. That we have a manager research department of about just under 20 folks that are dedicated by asset class and do diligence on each of these different areas. So in conjunction with the consulting team that's in front of you today, Spencer, myself, and Tracy, kind of going through and providing what we think on a broad level, what asset classes we should be invested in with the trust. We have a research group that helps define and do diligence on a deep level with each of these managers to try and make sure that we have the appropriate funds that meet the needs of the trust. So going back to a year and a half ago almost at this point, we did an entire education across what alternatives, all the areas of the basket clause, what they are, how they work, what the pros and cons are in terms of investments, but also on an administrative basis. The Investment Advisory Commission directed us towards private real estate after hearing all of those pieces. So we went through a series of 3 or 4 separate meetings outside of the normal quarterly meetings to do interviews with each of those managers that we brought forth. And again, those are the ones that our research team deems of the highest quality and the best to support our client base. So we did interviews with, I believe, 5 different managers, and including you already have 1 real estate manager in UBS. And then of those 5, based on various considerations and back and forth, the 2 that Dan mentioned were recommended and kind of endorsed by the Investment Advisory Commission and RBK, Harrison Street and Invesco. And from there, we did this very similar process, but with private credit, knowing the expansion of with the MLP dollars coming into the trust and wanting to make sure the trust is able to sustain on a long-term basis and diversify a little further. We did the same thing, but within private credit. That was kind of the second most desired area amongst the group after many discussions. We had our private credit team, which is different from our real estate team, meet several times with the commission and Dan to talk through pros and cons, provided a list of different managers, and in this case, different structure types in order to come to the final decision on PIMCO being that manager there. And just so we know, we only have a couple pages left here. The appendix is about 15 pages long, and we weren't planning to get into that. So really, this has been a long process that has been very measured in terms of the education aspect of RBK providing it to the Investment Advisory Commission and to Mr. Moore, and then going through down that path from a high level, what this asset class is, to how could it be implemented, to which managers should we select within each of these areas.
Thank you. That helps. Thank you, Mr. Chair.
So that kind of brings us to the next slide on 21. Before we get to the last slide that we plan to talk to on the conclusion, but this is really what the transition could look like should all of this be approved. And you have a current asset allocation within U.S. and international equity, U.S. public fixed income, international fixed income, with emerging markets debt, real estate. And then this kind of shows in the orange in the middle there how many of the roughly $230 million would be coming in, how that would be split out amongst different asset classes. Just to show you that over time, and this is something we would recommend not doing all at once. Obviously, the $230 million is coming to the trust, and we're trying to optimize how it comes to the trust over time. And we would anticipate 3 or 4 tranches about 3 to 5 weeks apart to try and make sure it's not all invested right at once at one time, in order to dollar cost average and avoid any sort of market drawdown that happens immediately after all the dollars are brought in. So trying to spread that out over time to maintain a conservative approach to getting invested. That kind of brings us to the conclusion, the summary of the presentation here. Ultimately, there's a handful of changes to the municipal code as we're being laid out. Dan laid out the dividend formula, how it will be smoothed over time, the 4.5% controlled spending policy that we're recommending, as well as the proposed expansion to real estate and basket clause from 5% to 10% each to diversify a little more away from the public markets within equity and fixed income, and help increase the probability of achieving that expected long-term 6.5% return to help support that 4.5% dividend plus inflation over time. At the bottom of the page, we kind of have what the next steps would be for RBK, the treasurer, and the investment advisory commission. These are things we've been working on for about, like I said, about a year and a half now. But what further steps would take place should this get approved next week? And that kind of brings me to the end of this. There's an appendix that goes through various different items. The full code here is in pages 25 to 28 here. And then we go through various other items like our assumptions for asset classes, additional historical performance, management fees for each of the managers already in the trust, as well as what the new ones are that the endorsement has come from the Investment Advisory Commission. That Nakubo study, there's a couple slides in there on comparisons for spending rates and asset allocation relative to some peers. And then the biographies for the IAC are in the back as well. But that's more, reference material unless somebody had specific questions there.
Great. Thank you so much for the presentation. We just have a few minutes left. Is there anyone else who would like to get in the queue, have any questions or comments? Not seeing anything. Any final thoughts from the administration or RVK?
This is Alex Slivka. I'd just like to take the time to both thank RVK and as well, obviously, Treasurer Dan Moore. What you see reflects just an ongoing pattern of Mr. Moore's 20-plus years in working with the municipality and shepherding this trust fund. And so this work has been done with a lot of thought, and I would, as Mr. Moore has said, I would urge the Assembly to approve his recommendations. Thank you.
I think Alex hit it on the head, and as we've mentioned, we've talked about this for some time now, and it's been a very measured process across multiple different entities. The Investment Advisory Commission, Mr. Moore is the treasurer, and then RBK. We kind of have a three-pronged approach to this, and making sure that everyone gets on board. There's full agreement across all of these recommendations. So it's been a very measured and lengthy process to get where we are today, and we all. Being the IAC, Mr. Moore, and RVK kind of have come to agreement with this, and would appreciate that leeway to operate as proposed.
Great, thank you so much. With that, I'm going to go ahead and close this work session and wish everyone a wonderful weekend.
Great, thanks everyone.
Thanks, Felix.
Thank you, everybody.
Felix.
Bye everyone.